working here with another video blog update. I'm coming to you this week from the studios of the Everything Financial radio program, where I just completed some interviews for this week's program. I want to talk to you today a little bit about some comments made by a very accomplished hedge fund manager. This gentleman's name is Stanley Druckenmiller. He was speaking at a conference, and there's a Zero Hedge blog that talks about some of the comments that he made. Now, Mr. Druckenmiller had average annual returns in excess of 30% for a 34-year time frame. So beginning in 1986 and going through 2010, Mr. Druckenmiller averaged over 30% returns annually. That's doubling money faster than once every 3 years. He's got a remarkable track record. I want to give you just a few comments that Mr. Druckenmiller made at the conference. He said, "Not a week goes by without someone extolling the virtues of the equity market." He said the obsession with short-term stimulus contrasts with a monetary reform of the 80s which led to the bull market, he said. He said, by most objective measures, we're deep into the longest period ever of excessively easy monetary policies, despite finally ending QE, or quantitative easing, or money printing. The Fed's radical dovishness continues today. 3 years ago on this stage, Mr. Druckenmiller spoke 3 years ago at this same conference. I criticized the rationale of Fed policy, but drew a bullish intermediate conclusion as the weight of the evidence suggested a tidal wave of central bank money worldwide would still propel financial assets higher. In other words, he predicted a bull market 3 years ago. He said, however, I now feel the weight of the evidence has shifted the other way. Higher valuations, 3 more years of unproductive corporate behavior, limits to further easing, and excessive borrowing from the future suggest that the bull market is exhausting itself. That's a conclusion that I came to last year. In fact, I have gone on record in my weekly newsletter, the Portfolio Watch, as saying that the highs in the market were reached May of last year. And I reached that conclusion about 9 months ago. At this point, it looks like that conclusion is spot on. Now, Druckenmiller, as you've probably already surmised, is bearish stocks. He said, volatility in global equity markets over the past year, which often precedes a major trend change, suggests that their risk-reward is negative without substantially lower prices and or structural reform, and he said, don't hold your breath for the latter. He said negative interest rates are absurd. He is bearish stocks and concluded by revealing what his biggest currency allocation is. And he was alluding to gold, although he didn't say gold by name. He said, some regard it as a metal, we regard it as a currency, and it remains our largest currency allocation. So here's a guy that averaged over 30% returns per year for 34 years who has gold as his largest holding. In my book, New Retirement Rules, I talked about the fact that had you had 10% of your assets in mining stocks in 1929 and 90% in the Dow, by the time the Dow bottomed, that 10% in gold mining stocks would have hedged your entire portfolio. Gold is a terrific hedge to a stock market decline. Gold is a terrific hedge to a continuing dollar devaluation. I would certainly, as I talk about in the book, encourage everyone to think about having some physical gold in their portfolio. On the second video blog update of this week, I'll talk more about that. And if you want a percentage, roughly speaking, somewhere between probably 10 and 15% is a good number to think about. Of course, the actual number will depend upon your individual financial situation. That's my first video blog update this week. Talk to you again soon.